This is Nightly Business Report with Bill Griffith and Sue Herrera.
Getting close. The Dow nears a new high as investor sentiment rises and trade concerns take a back seat.
Bringing up sales. It's not even autumn yet, but already forecasts for holiday spending are spreading cheer.
Smokin' hot. Money is pouring into the marijuana stocks, but will today's hype be tomorrow's buzzkill? Those stories and much more tonight on Nightly Business Report for Wednesday, September 19th.
And we do bid you good evening, everybody, and welcome. After 2 days of pretty decent gains this week, the Dow suddenly finds itself close to an all-time high. The financial sector led the way higher today, getting a lift from the continued rise in interest rates. Tech stocks did not participate in today's rally. Giants like Microsoft and Amazon traded lower. Here are the closing numbers for this day. The Dow advanced by 158 points to close at 26,405. The Nasdaq fell by 6. The S&P added 3. Mike Santoli takes a look now at the Dow's move toward new highs.
It's a sign that investors are coming to terms with the impact of the tariff wars, or simply believe the U.S. economy and American companies are strong enough to withstand any trade pressures. After a lively two-day rally, the Dow Jones Industrial Average has pulled within 1% of its all-time high of 26,616, set nearly 8 months ago. The latest stage of the Dow's advance has been led by shares of big global industrial stocks such as Boeing and Caterpillar, exactly the companies once considered most vulnerable to retaliation by China for U.S.-imposed tariffs on Chinese goods. The broader S&P 500 made a record high just a few weeks ago, helped in recent months by the huge gains in its big tech stock components. The Dow, though, was the index hardest hit by ongoing worries over the effect of trade skirmishes on U.S. manufacturing exports. Yet so far, analysts see only a marginal potential drag on orders and earnings as a result of the new tariffs on $200 billion in Chinese imports that were made official this week. Stock markets in Asia have also bounced, perhaps an indication that investors had already anticipated and priced in some of the tariff risks. Meantime, a rapid rise in Treasury yields, another factor that seemed to spook the markets early this year and contributed to the sharp 10% correction in February, is likewise being taken in stride. The 10-year yield has now climbed above 3% this week as the Federal Reserve likely prepares to lift interest rates next week and perhaps again in December. This relief rally supporting the Dow owes a lot to the consistently strong U.S. economic data and continued expectations for 20% earnings growth for a third straight quarter. The question for investors now, as the Dow nears a full recovery, is whether those economic tailwinds can carry this market into 2019 as the effect of the U.S. tax cut wanes and interest rates march higher. For Nightly Business Report, I'm Mike Santoli.
So let's turn to our bull and our bear guests tonight for their opposing views on this market. Jason Draho is the head of America's asset allocation at UBS Global Wealth Management. He says that this bull market does indeed have more room to run. Our bear tonight is Lamar Villery, portfolio manager at Villery & Company, who sees some risks ahead for the market. Gentlemen, welcome. Nice to have you with us. Jason, I think Mike Santoli made some very interesting points at the end of his report. Rising rates, valuations that seem kind of rich by many, many standards. Why do you think that the market has more room to run?
It's quite simple. It comes down to the economic fundamentals. As you alluded to, growth in the U.S. is very solid. The momentum is solid. There's no reason to expect that to diminish anytime soon. And without any signs of recession risk, certainly in the next 12 months, it's hard to see the bull market coming to an end. It may not keep grinding higher as quickly, but the fundamentals are still very supportive.
Lamar, Bank of America said today that the great bull is dead, that we should expect a bear at some point, and in part because the Fed is raising rates. There's that long-held feeling that the Fed lowering rates over the last decade was responsible for the great rally. Now that they're reversing course, the stock market has to do the same. Does that have a feeling of the same that you have for this bear market right now coming, that you feel?
Sure. I do think that's one of the catalysts that we're concerned about. If you look at the fact that over the last several years, what we've seen is investors fleeing bonds because there's just no yield there and buying these high dividend paying stocks. In fact, making some of these very sleepy, slow growth stocks wildly outperform their much faster growing peers. And for a while, that from our perspective, that didn't make any sense. But if you're sitting there trying to make some money for your retirement and the treasuries are paying you 2%, you got to find a yield somewhere. So I think we're a little concerned that there's going to be a real reversal of that trade and people move back into bonds.
Jason, one of the things you watch is the bull market monitor, which is correlated to economic expansion. There are those who would push back on that and say, if you look at history, just because the economy is good doesn't always mean that the stock market is going to be good. What's your response to that?
It's true that the correlation between economic growth and the stock market is actually quite low on a year-to-year basis. But if you're looking about the bull market ending or bear market starting, it's really hard to have that happen unless there's a recession. Mm-hmm. And the economic fundamentals just suggest that's not the case. Growth is very good. It's likely to continue. And I do agree that I think rising interest rates are a concern. But by historical measures and relative to the strength of the economy, interest rates are still low. And the Fed's going to raise rates, and that will become a concern. But I think that becomes a concern not until late next year and really 2020. There's still definitely room for this to kind of continue on before I think those become material risks for the bull market.
What would you buy here, Jason? What's going to take us higher?
So the performance today I think is interesting. Financials did well, tech didn't. We've been of the view that value stocks should perform well in this environment of good growth, rising rates, rising inflation. If this continues, and if the fears of sort of kind of a growth slowdown because of trade concerns have actually abated, that should be an environment that would support value stocks like financials, like energy. So that's one area that we'd be looking to buy.
And I guess the same question on the other side of the coin for you, Lamar. How would you be hedging your bets if indeed we are going into a more negative cycle for the stock market?
So there's definitely securities you can buy, individual names, like we buy individual stocks that might actually perform better in a rising interest rate environment. One of the ones we've been buying is Progressive. That's a situation where rising interest rates actually help them to do better with their invested assets. So there are securities where you can really negate that risk.
Jason, Lamar, thank you so much for joining us for our bull-bear debate tonight. Bill?
Elsewhere in other news today, the head of the Chamber of Commerce said today that the White House can still avoid an all-out global trade war at this point. The business group called it the biggest threat facing the economy right now, and it's urging the administration to seal a trilateral NAFTA deal and make progress with Europe on its trade issues. It also wants the U.S. to talk with China rather than resorting to trade retaliation.
But the relationship between the U.S. and China may already be starting to sour. In an interview with a Chinese publication, Alibabas Jack Ma backed down from a promise to bring 1 million jobs to the U.S., citing those ongoing trade conflicts between the U.S. and China. Ma said, quote, "The promise was made on the premise of friendly U.S.-China partnership and rational trade relations. That premise no longer exists today, and so our promise cannot be fulfilled," end quote.
And in fact, today, China's second in command had some harsh words about the rise of protectionism in some parts of the world. Eunice Yoon is in Beijing for us tonight.
China's Premier Li Keqiang spoke at the World Economic Forum in the port city of Tianjin today. He didn't directly address the escalating trade war with the United States or even mention President Trump's name. Instead, he referenced concerns of rising protectionism and repeated China's promises to open up the economy and give foreign investors fair treatment. On the currency, Li said China would not actively weaken the yuan to help exporters or engage in competitive currency devaluations, but would keep the yuan stable. What was also missing in the speech was any recognition of China's contribution to the rising protectionism among its trading partners. The state media had its typical strident response, saying China will outlast the tariff war, emerge stronger, and it's not afraid of President Trump's what they called extreme measures. One commentary in the Communist Party-run People's Daily argued that President Trump's trade action doesn't necessarily impede China's own economic agenda. The People's Daily said China will instead use the trade dispute as an opportunity to replace imports, promote localization, or develop export-oriented advanced manufacturing. What often gets lost in who wins or loses a trade war is that a big part of China's Made in China 2025 strategy is to develop homegrown technology so China can rely less on foreign technology and other industries. So that's what the piece is highlighting, that China could be better off in the long run because it wants to develop its own technologies of the future. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Meantime, trade talks with Canada resumed today in Washington, talks that U.S. officials want to see completed by the end of the month. Ilan Mui has more.
Top trade officials from the U.S. and Canada are back in Washington, hoping to nail down a deal on NAFTA. Canada's Foreign Minister Chrystia Freeland told reporters that the talks have been constructive, but more work needs to be done.
We are a country that is good at finding compromises, and that's a talent our negotiators certainly demonstrate. At the same time, our core objective today, and this has been the case from the very beginning, is to defend the national interest, and that is what we are going to continue to do.
October 1st is the deadline for negotiators to produce the written text of a formal deal, and it's unclear if they'll be able to pull that off if they don't reach an agreement in principle by the end of this week. The deadline is designed to give Congress plenty of time to review the deal. Lawmakers must vote to accept any trade agreement, and some of them are getting a little bit antsy. Congressman Steve Scalise, a member of GOP leadership, warned that lawmakers will not short-circuit the open, transparent, and accountable process. If negotiators can't reach a deal, he said, Congress will have no choice but to consider other options. But when it comes to China, Congress is taking a back seat as President Trump turns up the heat with new tariffs on the country's exports. Nearly a dozen bills have been introduced over the past few months to rein in President Trump's trade powers by requiring more consultation with Congress. None of those bills have gotten very far, however, leaving one Republican senator saying he feels like a helpless bystander. For Nightly Business Report, I'm Ilan Mui in Washington.
Time to take a look now at some of today's upgrades and downgrades. We start with Intel. The price target there was cut to $50 from $56 at Morgan Stanley. The analyst cited ongoing delays of one of the company's processors, but the firm did maintain its equal weight on the stock, equal rating. Shares of the Dow component were up 5 cents today to $46.15. Guggenheim raised its price target on Netflix to $420 from $360. The analyst cited the company's growth opportunity in India in particular. The firm maintained its buy rating. Stock, however, fell a fraction to $366.96 today. And E-Trade was upgraded to buy from hold at Jefferies. The analyst there says that E-Trade is a takeover candidate. He says the valuation is attractive. Price target $65. That stock rose more than 3% today to $55.78.
And still ahead, why retailers have 1 trillion reasons to rejoice this holiday season. European regulators want to know more about how Amazon uses its data. The Competition Commissioner has launched a preliminary look at whether Amazon uses information from small retailers to help increase its own sales.
It is very early days in this antitrust investigation into Amazon's business practices. We are gathering information on the issue, and we have sent quite a number of questionnaires to market participants in order to understand this issue in full.
The European Union recently fined Alphabet's Google for allegedly abusing the dominance of its search engine and Android operating systems to favor its own services, a decision that Google is appealing.
Meanwhile, Amazon is taking a larger chunk of the digital ad market. According to a new study, the company is on track now to be number 3 in that category this year, behind Google and Facebook. Amazon is projected to take in more than $4.5 billion in digital ad revenue, thanks to strong organic growth and to accounting changes.
And Amazon may be one of the many winners this holiday shopping season as consumers get ready to open up their wallets. Courtney Reagan breaks down the spending forecast.
Less than 100 days to go until Christmas, and it's already looking like a jolly season for retail. Various forecasts from retail consultancy groups predict total holiday sales will grow between 3% and more than 5.5%. Deloitte estimates sales will top $1.1 trillion. Online sales are expected to grow between 16% and 22%, with e-commerce making up as much as 20% of all holiday spending. The forecasts are robust compared to both the historical average and because it represents solid growth on top of last year's strong season. The economists calculating the forecast say strong consumer sentiment, low unemployment, and stable savings rates are overpowering risks for now. But a significant decline in the stock market or higher prices from new tariffs could change the outlooks from being as rosy as Santa's cheeks. For Nightly Business Report, I'm Courtney Reagan.
So let's turn to Deloitte's Rod Sides for more on this holiday spending forecast. He is the U.S. retail leader with his firm's retail and distribution practice. Rod, thanks for joining us tonight.
Thanks for having me.
You're a pretty popular guy today with this kind of a forecast here. You know, we talked in the past about retailers scrambling to find a way to go after Amazon with their online practice, but I guess they've found a balance and they're going to get good demand this year. That's the message you put out today, right?
Absolutely, and we hope so. You know, if you look at the fundamentals with the savings rate being up and being pretty stable, we believe it's going to really translate into a great holiday season.
Are there risks to that? I mean, there's a lot going on in Washington. We have a possible trade war with China. Does the consumer basically put that aside and they're feeling pretty good about the economy and they continue to spend?
Yeah, I think the consumer has gotten used to a lot of the noise that's coming out of Washington. So as a result, I think the consumer looks at their own pocketbook, really understands where they are, and to use that as a gauge to determine how much they're going to spend. So we think that the consumer is going to continue to be really excited about this holiday.
Are there categories that you especially like, whether it's apparel or technology or whatever it is?
You know, there's a couple I think that usually do pretty well in an up economy. Luxury does pretty well as an overall grouping. So some of those items will be jewelry, et cetera, typically has ticked up over the last couple of years. Technology, certainly, if we have new innovations, do pretty well in this season. And everybody always wants to buy apparel for whatever reason over the holidays. So I think all those categories will do quite well.
You know, one of the things that I've noticed, because I end up doing this every year, is I wait too long and then I have to express the gifts for Christmas. But a lot of the retailers, it seems to me, have gotten very good at anticipating people like me, the last-minute shopper, and that helps their bottom line.
Oh, it certainly does. And being able to shorten the windows for delivery certainly helps their ability to meet that demand. I, like you, find myself scrambling at the last minute, and so being able to meet those promised ship dates are really important to make sure you get it by the holiday.
Mm-hmm.
There will be winners, but what about losers? Anybody that you feel will lag this year or struggle?
You know, I think if you don't have a very specific value proposition for the consumer, you're always going to struggle. So what we find is that when you have unique product and distinctive product, or if you're trading on price, both ends of those spectrums have done quite well. It's the businesses that are stuck in the middle that really don't have an identity that I think will struggle over this holiday.
Rod, good to see you. I would say to both you and Sue, it's never too early to start shopping. Rod Sides with Deloitte joining us tonight from Minneapolis.
I do it every year. Profits stall at the used car seller Copart, and that's where we begin tonight's Market Focus. The online auction company topped revenue estimates, but said the disappointing earnings were largely due to costs associated with Hurricane Harvey. Copart said it spent nearly $80 million on temporary storage facilities, overtime wages, and employee lodging. Copart shares skidded 13%, 55.58. Goldman Sachs is reportedly nearing a deal to sell its Simon app, which sells complex investment products. The Wall Street Journal says a number of rival banks, including J.P. Morgan and Wells Fargo, are in advanced talks with Goldman about making investments in that business. Shares of Goldman Sachs rose nearly 3% to $235.58.
Drug maker CRISPR Therapeutics said that it is planning to offer $200 million worth of its common stock in a new public offering. And as often happens, the news of a secondary offering initially sent shares of that company lower in the extended session tonight. It also finished the regular session down about 2% at 51.89. And then after the bell, software company Red Hat said a rise in subscription revenue helped overall earnings top expectations. Total sales did miss estimates, but the company gave weaker than expected guidance for the current quarter, and so shares initially fell in the after hours. They finished the regular day up a fraction to 143.16. And the stock of the day had to be Canadian marijuana company Tilray. Shares of most of the cannabis-related stocks have been on a tear lately anyway, but today was just crazy. Trading in Tilray had to be halted 5 different times during the regular session. all due to tremendous volatility. When all was said and done, the stock finished up another 38% to $214.06. And since its initial public offering just back on July 19th, shares of Tilray are up more than 1,000%.
Which got us thinking, because it's estimated that the marijuana industry on a global scale could be worth nearly $60 billion in less than a decade. Corona maker Constellation Brands invested billions into a cannabis producer, and Coca-Cola said it is closely watching the market for drink infused with CBD, that is the non-psychoactive component in marijuana. So should investors consider getting in on the action? Troy Dayton joins us now to discuss that. He is the co-founder of the ArcView Group. Troy, welcome. Nice to have you here. What a day to have you here.
Thanks for having me. Yeah, what a day.
So tell me where you think we are with the cannabis industry, specifically the stocks, because Bill and I both saw the dot-com bubble, and it reminds me of that, frankly.
Yeah, I mean, people are clearly very excited about the cannabis industry, and the performance of these stocks over the last few days and past few months really shows that. But the prices of these companies, I mean, they're bananas. I mean, there's no way that that's going to stand over time. That being said, there are real fundamentals to this market. It's growing at a 26% compound annual growth rate over the next 5 years. And people love cannabis, and they're very excited. The public opinion is moving very far in favor of legalization, and there's a lot of hope for additional policy reform. And so over time, I think people will grow into these, companies will grow into these valuations, but there's going to be a lot of volatility along the way.
That policy reform you're referring to, obviously, cannabis is still illegal at the federal level and in some states still here in the United States. That's a major headwind for this industry, right?
Absolutely. It's part of what makes it so interesting to see all these stocks raising so much, because a lot of that money can't get into the U.S. right now. And so I think there's a lot of excitement and thinking that policy change is going to happen. And I sure hope all the people who are making so much money on these stocks are going to use some of it to donate to the legalization effort, because right now there are still millions of people that wake up every day in fear of their government for these laws, while we're all trying to make as much money. But I think the real opportunity right now is in private companies. Since the public stocks are so overvalued at the moment, the opportunity is really getting into these companies before they go public.
And is
and that's what we really focus on.
Very quickly, is that the way that corporate America should play it? Because if you're a publicly traded company buying into an industry that, as Bill mentioned, federally is illegal, I mean, that's kind of a dicey proposition. Should they go to the private companies?
Absolutely. Private or public, you still have the same legal issues to deal with, and that's why so many companies are looking at Canada and other countries that are passing laws as a place to begin, or investing in ancillary companies. You know, you see companies like Scotts Miracle-Gro that are doing agricultural technology and these sorts of things, kind of businesses that grow with the industry.
No pun intended. Okay, Troy, thank you very much. Troy Dayton with ArcView Group.
Thanks for having me.
Coming up, the cost of the cleanup.
The global poverty rate has fallen to a record low. The World Bank says the proportion of people living below the poverty line has fallen to 10%. But the World Bank also warned that the pace of poverty reduction has slowed. The World Bank has a goal of reducing the poverty rate to 3% by the year 2030.
President Trump flew to North Carolina today, where he toured the damage from Hurricane Florence. He assessed the response and promised to help those displaced.
Hurricane Florence was one of the most powerful storms ever to hit the Carolinas, one of the most powerful and devastating storms ever to hit our country. To the families who have lost loved ones, America grieves with you, and our hearts break for you. God bless you.
President also predicted a costly cleanup, which is underway with a focus on getting people back into their homes and businesses back up and running. Seema Modi is in hard-hit New Bern, North Carolina for us tonight.
The hurricane has passed, but the flooding and water damage is wreaking havoc across the Carolinas. Here in New Bern, population of 30,000, over 4,000 homes have been damaged or destroyed.
I don't have flood homeowners insurance, so we're kind of on our own.
Some people lost their homes completely, and I just got moderate damage to mine.
New Bern's Conference Center, a key revenue generator, has suffered water damage, prompting local officials to bring in external help to expedite the repairs.
The biggest problem you have with moisture is when it's on the ground, it also rises up and it damages other parts of the building. So right now we're stabilizing the environment, getting all the wet material out that we can, and getting it ready to be rebuilt after we leave.
Complicating the recovery efforts, access to power. Over 200,000 residents are dealing with power outages, and Duke Energy says most of the power will be restored by next Wednesday.
We're almost ready for you, okay?
For those still without power and a place to stay, aid groups like Operation Blessing are providing food and supplies in partnership with Home Depot, as well as generous donations coming in from nearby states. Based on early estimates, Florence could inflict as much as $22 billion in damages. And the longer the recovery takes, the greater the economic hit on this region. CNBC Business News, Seema Modi, New Bern, North Carolina.
And that's it for us.
Good night. See you tomorrow.